Good evening, everyone. It's great to be here with you, and it does feel a little bit like we're turning a new page with the weather outside, and hopefully we all get to enjoy that weather with our families. And we have a couple little ones at home, 4 and a 6-year-old, and they're keeping us very busy, staying at home for the last 2 months, working 12, 14-hour days, and also being a teacher or homeschooling and making sure they do that has been a challenge, I need to tell you. So I sympathize with everyone that is in a similar situation. And if you have maybe older kids, then you are in a luckier position. I wanted to, before I get started, we were talking about navigating the COVID crash and what has been on everyone's mind and what the media has been talking about. I find that over time, there's a lot of noise. We end up sitting in front of the TV, listening to what is the update, what's the latest, what's the news, and COVID cases, and outcomes, the drama that plays out with politics at the same time, and also on the stock market. So we certainly understand that there's risk that happens when something like COVID affects the economy. But I think that the media has their job in a way is to dramatize the situation to a greater degree, because there's a lot of attention. If more attention is in fact paid to the media, the revenue comes from commercials. So I learned that over time, and I stopped watching mainstream media, and I only then focus on the facts because I just wanted to know the numbers, not the drama or the multiple opinions from every single side. Although sometimes that's nice to have as well. And there certainly isn't, a shortage of opinions when it comes to the market, what will happen. What I wanted to, before I get started, to draw the big picture is most of the time, we look at markets and investments and we know what will happen, because that's, in the long run, the market goes up. And that's about 8 out of 10 years. And then for 2 out of the 10 years, that seems to be a time of more of chaos and so often uncertainty, sometimes wrong decisions. But I think individuals also don't pay enough attention and don't have a plan that helps to recognize the value of that and the benefit of the market dropping. Certainly in the economy, I mean, it's not generally a good thing, but it is a natural thing, and we're not the ones making it happen. We're just participants in what's happening. And what I wanted to focus is in that time where the market actually does go down for a year or two, which is the period that we are in right now. And the argument or the point that I really want to share with you is that as long as there's a plan through that period, volatility is okay. In fact, once you develop a positive feedback loop of what you should do or you can do when the market is down, you would, in fact, anticipate volatility. That's something that initially, when I saw in the first market crash, I was a little bit maybe caught off guard back in 2008, although it was a pretty deep recession. There was more certainty, that the market is going to rebound. It is a matter of time by the time that the market rebounds. It's not if. And so if we know that, we can draw some conclusions. And I want to share some of these points with you. So getting started, this is our great team, Michelle, Matt, and Monica. We have 6 topics to cover. Economic metrics that are happening during the lockdown right now that we're just getting numbers on. The strong economic indicators that we've been seeing before COVID, which are very important. Market cycles and long-term view of the markets, bonds and fixed income markets, and then on the other side, investments and equity markets and the volatility of that. So getting started, I'm not sure if everybody knows, but this was the longest growth cycle that our economy has seen since 1945. That's about 80 years. And because it is the longest, and that dotted line in the middle shows us the average, and the other expansions in the past, you can see them being much shorter. We have been anticipating this for the last 2-3 years, I would say. And although the economy was chugging along pretty good, at this time is not the time to look for additional risk. In fact, you would want to reduce the risk and look at, let's maybe be conservative and save that opportunity for when the market drops. So G7 countries, there is a harmonious behavior to the economies in the G7 countries, have had recessions forever. And going back to the 1960s, we see that tight monetary policy, bursting credit bubbles, oil price shocks, bursting housing bubbles, banking crisis, tight fiscal policies, all of those reasons of why recessions happen. And you can see how long they lasted with the number of months right above the bars. All those were financial reasons, financial causes. To this list, now we can add infectious diseases, which is an anomaly. It stands out. And the last time this happened, I looked up the Spanish flu back in the late 1920s and what happened to the economy and to the markets. I do encourage you to have a look back, because if you look to that period and where we went from there and where we are now, and the Spanish flu was a much worse situation than COVID is, based on the death rates from what history tells us. So this was somewhat unanticipated, but we know that it happens. In fact, the World Economic Forum, in its global risk report for 2020, before COVID happened, did identify that infectious diseases were a global threat. And I have the 4 red pointing arrows to that, and you can see that at the bottom there's the likelihood of that happening, and on the left-hand side there's that impact of what, if that happened, what it would do. So certainly they identified this as a low likelihood of happening and a high impact. Now, not all the economies are affected in the same way around the world, and I would say that North America is a little bit more isolated than other countries, because if we look at tourism, travel, and entertainment, which are the main industries around the world, US and Canada does rely on about 9% of its economy is derived from tourism. Whereas if we look at Spain and Italy, that's about 15%. And further down the line, Greece at 26, 27% almost. We know that those countries will be hit harder than North America will. So then what we do know is that China was going through the COVID shutdown a couple months before North America. And they gave us a little bit of a glimpse of what happens to the economy. So you can see that the Chinese economy growing at the strong 10% and recently more like 6%. But then that drop that happened towards the end. And that drop, the shrinkage is about 15% of GDP that was experienced. Now, that was initially when that lockdown started. Subsequently, when the economy reopened, we also see a V-shaped recovery. That recovery is not what we normally see during a recession. Normally, that there's a breaking down of the economy and then slow building up. Whereas this type of pattern is more like an induced coma or a pause on the economy, where the government says, for a while, let's just sit back home and not work, not do anything. And we'll tell you when to get started. And when that happens, everybody goes back out, and for the most part, jobs are out there. And some businesses may suffer, but if a business goes for a couple months without revenue, and because of that they go bankrupt, then that wasn't a healthy business to start with. Now, looking at GDP in the US, we're seeing a very similar pattern where that line just dropped. It's not gradually going down like it would be during a regular recession. We see a steep drop. And this drop is now expected to be followed by a similar V-shaped recovery, and like China has been experiencing. Looking at Canada, we see that the first 2 quarters of the year are definitely showing us down numbers. And the second part of the year, the expectation is that those numbers will be made up. An analogy to this is when physicians work in a hospital or they work in clinics, and their patients are staying back at home. They're not coming to see them. That doesn't mean that they're getting better. What it means is that when the offices reopen and it's safe to step into a hospital, now there will be a greater flood of patients coming in. And that is very similar with many other parts of the economy, including the food industry, where in the US, they're saying that there's a shortage even of food supply in the system. And if we don't reopen soon, then that will be a problem. So looking at the GDP numbers, what we're seeing is that, that 2019 column where globally we grew at 3%, 2020 economy is expected to shrink 3%. And the shrinkage in the US and Canada is about 6% there. 2021 as you can see, the expectation is actually to recover the numbers that we lost in 2020 and do the regular that we would have done. So, these numbers are actually interesting because they are forecast numbers, and forecasts work well if nothing out of the ordinary happens. So we do, for example, if we had a second wave of COVID in the fall or winter, then we could see these numbers be significantly changed. That's yet to be seen. However, what is encouraging about this is that it's showing us a different pattern. In 2008, when we had a financial crisis, the economy was being destroyed. So equity values of homes were being lost, and companies were going bankrupt. And therefore, people were losing jobs. And those jobs were not going to be there for people when they get back to work again. Whereas this time, it's because of it happening that way, it's actually expected that the impact of COVID will be lesser than the financial crisis. And some are estimating that maybe half of that. Nevertheless, we're seeing markets react in negative ways. And so what happens to asset performance during periods of recession is depicted here in this graph, where the gray bar, you're seeing the average of a recession. The red bar is what just happened right now in the last few months. So on average, the S&P, which is the U.S. index that we track of the stock market, drops 36%. This time we dropped 34%. Metals drop about 37%. We dropped about 28%. Then oil drops about 44%. This time we dropped 70%. And so this number is definitely over-exaggerated based on the past. And that's because, for sure, I know in our house, we're fueling up once every 3 weeks. I would expect similar would be for everyone else. Therefore, demand is down. But at the same time as this was happening, Saudi Arabia was encouraging Russia to drop production. Russia didn't agree to that. And Saudi Arabia said, well, if that's how you want to play, we'll play hardball and we'll increase production. We'll see what that will do to you. So they were playing this aggressive game, which it was obviously a lose game in the short run, but the hope was that for the long run, they'll be on the same page. So Russia did finally agree that, let's cut production. But by then it was too late. Oil has gone down to very low numbers. In fact, some contracts were selling at negative prices. So people that had oil were paying somebody to take them off their hand, the barrels off their hands, because they had nowhere way of storing them, which is sometimes unusual when that happens. Now, the American dollar during every recession is a place where investors feel confident holding their assets in. So during the 2008 recession, the American dollar went up, and recently the American dollar also went up. To the point where we are, in fact, encouraging clients that have American dollars but don't necessarily need them for anything specific, that you probably will not get a better exchange rate any other time than you are right now over the next, and maybe for the next few months. This also has certainly helped our investment portfolio, because if we're invested, let's say 30% of the portfolio is allocated in the U.S., then that 30%, the market goes down, but that dollar increase for Canadians actually bumped up the rates of returns for us, which was great to see in the portfolio. On the flip side, if we are holding debt in American dollars, maybe some property was bought and a mortgage is held in US dollars, then that will make that debt more expensive. All of this is actually causing a lot of stress in the system, and stress levels of COVID are in short term similar to those of the financial crisis, which has caused the Federal Reserve and the federal government to react. So we're seeing central banks in Canada and in the US and around the world cutting rates. Rates in Canada are 0.25%, same in the US. And then on top of that, if we had 2% buffer, which is what the banks charge, then we're in the low 2% for a prime rate, which is excellent when you're refinancing your house or you have lines of credit. Because at the end of the day, the whole point of lowering rates is that when we pay less in interest, leaves more money in our pocket. And that money always finds its way into the system and spending. And that's the whole purpose why the government lowers rates. On the other side, the federal government has done some very aggressive stimulus right from the beginning. So it was just tremendous how quickly the governments responded to this situation. We've never seen them do it so fast and with such large amounts. So about 3 times more money was thrown at the economy by the federal government this time than it was during the financial crisis. And remember, the financial crisis was, up until now at least, it was a much worse situation. So if we put those numbers in relative terms, it's almost as if the economy is seeing about 6 times more stimulus money being thrown at the situation at the problem than it was 12 years ago. And when this happened, stock markets rebounded tremendously. So we just ended up going to negative 35, and we're at negative 15 now. What is a little bit confusing about that is that we don't see an end in sight for COVID, yet the stock market is showing us positivity. And it's not because we have a vaccine or things are fixed. It's because there's just that sense of relief that whoever's staying at home has the money to buy food, and lower interest rates allow for asset prices to be higher. And it's a little bit almost unfair to be able to distinguish if you're a good business or you're a good analyst and you know which companies you should buy. Well, the ones that are not so good are also winning as a result. So the amount of money is like I said, significant, and we're over $2 trillion now, closer to $3 trillion in the U.S., whereas in 2009 that package was about just under $1 trillion, and it looks like the budgets of the governments are going to be doubled, if not tripled. So in Canada, we're seeing that Canada goes into in deficit about 30 billion. This year will be down about 100 billion. With all the stimulus and money being thrown by the government, the question surfaces, where are we going to get this money from? And so we looked at the numbers there, and what it's showing us, or the way to look at it, is the percentage of debt relative to the country's GDP. So if we're looking at Canada, 26% of debt relative to the annual GDP, it's actually a pretty healthy number, and to be honest, somewhat surprising. I remember back at school when I was in high school, university, I'm pretty sure those numbers were a lot higher, and they were a problem. We used to hear about them in the news all the time. So 26 is healthy. U.S. is sitting at 80. With the stimulus package, it will put them over 100. The number 100 is somewhat relevant because anything below 100% is seen as relatively healthy, whereas above 100% is more troublesome. So Italy, for example, you're seeing there 121. That's definitely higher, and they were also hit with COVID pretty bad, and they rely on tourism. For reasons like that, we don't see Europe or Italy or Spain, countries there be winners out of this, or relative. No, I don't think anyone is a winner, but it's relatively they're in a worse situation. Something that will certainly come out of this, or almost certainly, is that the federal government will probably reassess of what is manufactured in China, and what will be mandated to be manufactured back at home. And I'm referring to medical supplies and medical equipment. Here we're saying that China has been the production house of the world, and when we're seeing that the goods don't come from China because the supply chain was disrupted because China was experiencing COVID first, and then the U.S. closes its borders for products to come through from China through the U.S. to Canada, then that really puts the country at risk. And this is something likely when the dust settles that the federal government will be looking at this closer. So the next stage is looking at the economic indicators before COVID. And why is that important? Because we did anticipate that it was expected that a recession would be coming. We didn't know what would be the cause of the recession and when it will come. But imagine that we did have one and it was caused by a financial matter as opposed to a natural situation like COVID. And then we got COVID. Then we would be hit with a double whammy of negative news to deal with. So why that is important is a strong economy is like a strong immune system. And if we're going to be hit with something negative, then a stronger immune system will be able to handle it better. And we're looking at unemployment rates in the U.S. We were sitting at 60-year lows. In Canada, we were at 40-year lows. And even Europe had its unemployment at a low point. So everybody that wanted a job had a job. And therefore, we were able to spend. Lightweight vehicle sales were growing and steady. Industrial production has been climbing over the last 12 years. Housing starts and retail sales. iPads, iPhones, and everything else that people buy. Even if we pulled up to the mall during the day, you'd have a hard time finding a parking spot, which showed that the economy was strong. Specifically in Canada, we also benefited from the increased value of housing prices. Looking at Spain and Italy, for example, out of the G7 countries, their real estate has been down in the last 10 years. They haven't seen any growth. Some countries have seen moderate growth. But if you look at Canada, that blue line at the top, what it means is that if we bought a house 10 years ago for $500,000, today it's worth over $1 million. And that house now, we're able to have a line of credit on it. And so nobody wants to live off of that. However, what it offers is a security blanket. It's a backup plan that if I don't have income, at least I do have enough money, access to money to put food on the table. And switching gears now to talk about market cycles and the long-term view of markets. We are aware that markets go up in the long run, and we see that here in the chart. So if $1,000 invested in 1925 would be worth over $1 million today because of that. But that road is not straight. There are bumps along the way, and those bumps is what recession is. So recession or problems in the economy. But then we do work our way out of that problem, and the market keeps going up. So when we look at it, every single time the market actually goes down, it becomes a pretty interesting opportunity because prices are rolled back and investments go on sale at that point, if we look at it from that angle. Zooming in on that, if you look at any given year, for example, 1980, so that first bar, we will have negative returns at any point in time, and up to negative 20% is very normal for the market to behave. But 9 out of 10 times, even though throughout the year there will be a negative point, markets will finish on a positive. So in 1980, the market was down at negative 17 at some point, but it finished at 26. And those green bars are showing you what the market finished at. What I wanted to focus on is the anomalies. So the negative 34, the negative 30, 34, negative 49, that's when markets went beyond the negative 20, which is bear market territory. And that's when it becomes interesting, because right after that, you see that the market actually was up almost every single time. And that's why looking at it from different angles is important. When we zoom in on a recession, what it means is that GDP actually decreases. And so if we're working at 100% GDP there, you see, the blue lines show us that most of the time, even when we have a recession, we recover from a recession within a year. Then sometimes that recession takes about 2 years to recover, and those are the orange lines. Financial crisis, on the other hand, that was one of the toughest recessions we've gone through, where it took 4 years for that situation to play itself out. So on average, what we see is that market drops during a recession for a period of 1.3 years, and we lose about 38%. And then the growth part is 6.6 years and 339%. These are the averages, and this here is what actually happens. So the blue fields show you the growth period of the market, and the yellow shows you the recession times. And there are gray columns that coincide with market being down and the recession happening at the same time. And when you look at the chart this way, and that's over time that I started looking at it this way, you do see that if I had the opportunity of adding money to my investment account, if I was doing it towards the end of that growth blue cycle, that wouldn't be the best time. The best time would be doing it at the bottom or at any time during the yellow period, because that's pretty much eliminates the risk, and I have now growth to look forward to. In fact, in the short run, we don't know what will happen because there can be a number of different outcomes. over a 1 month period in red, 6 month in yellow, or 1 year in green, you can see that 1 year later, the markets could be up or they could be down. When we look at the longer period, that's when we have a higher level of certainty. And so if we look at a 5-year period after the recession, we're seeing that markets can be at 50% or even 100%. And that's what we should be focusing on when looking at the investment allocation, as opposed to short term. And by that I mean, in the short run, I think there's a tendency that we all want to find that bottom, and we want to buy at the lowest possible prices. So let's say we do agree that buying into the market is a good opportunity, but I want to buy in at negative 35 or negative 40 instead of negative 30 or negative 25. Will we benefit from that 5 or 10% buying slightly lower? Yes, but that's not the same. So fast forward 10 years or 5 years, and we're talking about making a gain of 90% as opposed to 100%. But the problem is that because many individuals want to focus on the bottom fishing or bottom buying at the lowest level, they often miss the buying opportunity altogether. And that's where behavioral finance steps in. And we're seeing that wanting to make that best decision, we can actually hurt ourselves. So looking a little bit closer at bonds and fixed income market. So as interest rates have been climbing, we also saw the bond yield go up, and it peaked at about 3% there. And then subsequently rates went, bond yields started coming down. And with the recent rate cuts of 1.5%, bonds are sitting at all-time lows. So we own bonds for 2 reasons. One, because we want to receive that income from the yield, which right now is not there at 0.5%. And 2, because we don't want to lose money. And that may be the reason why we hold on to bonds right now, because it's a place of safety. Bonds, the bond yield goes down, but the value of the bond can actually generate growth during times of recession. So in fact, when stocks drop, bonds go up. And that's the reverse relationship that we are looking for, which creates stability in the portfolio. For a 1 to 3 year bond yield currently, the Government of Canada bond, we're seeing rates at about 30 basis points or 0.3%. It's not very encouraging. GACs will be at similar rates. If you look back at history, at the 1980s, bond yields were at 15%. I wouldn't need the stock market if I was getting 15% guaranteed. That was a time where also we had mortgage rates being high and interest rates being high. So it was on both sides. Now, over the last 40 years, those rates have come down, and they are at 0.25%. We're seeing that bond yields are low everywhere. Germany, Switzerland, Japan, France, and some countries have even negative yield bonds. We won't get into that conversation today. It's a little bit confusing to understand sometimes how that can be. So switching gears from bonds to the investment to equities and investment management during volatility. And volatility, or specifically during the bear market. Bear market is when the market goes below negative 20%, negative 30, 40, 50. And keep in mind that portfolios generally, they should be in a similar breakdown like this pie here. So 70-30, 30% in bonds, 70% in equities. And there are 2 different factors that we need to differentiate from. Risk is the probability of a permanent long-term loss of value. So buying an investment that will not rebound, that will just go bankrupt. And volatility is when we do see quality investments that are not likely going to go bankrupt, but they do drop in price. That's volatility. The assumption here is that we're not playing with penny stocks, or we're not looking to have a crystal ball and figure out which little company will become, the next Facebook. We're looking at larger companies or mid-sized companies that we know have been around, kind of like Bell. Bell will go down during this period in sympathy with the market, but we don't cancel our telephone subscription during a recession, and therefore those businesses have a lot more resilience. We will take a look at 4 different options of what can happen when the market is down. So in a time where the market drops, we'll see different behavior from different individuals. And that is based on some programming that happened over the past. And some of the negative feedback loops that have been developed will play themselves out in a situation where, let's say we started with $1 million portfolio and the market drops 20%. And at that point, somebody has that sense of fear and they will want to sell those investments. And they'll say, yeah, I won't get back in until everything is kind of back on track. When that happens, we do wait for the market to rebound, but now we don't have $1 million to invest. It's $860,000. So effectively, in the selling scenario, whether you sell at negative 20, 30, 40, or 50, even worse, you will be shrinking the value of the investment portfolio, not growing it. Option 2 is to do nothing. This is actually not a bad approach to looking at things, because if we have $1 million and we do go through a recession where we go to negative 20, 30, 40, 50, then the markets rebound, they come back to where they were, we haven't lost anything. Many individuals have told me in the past that they just rather not look at statements and what their account is worth, because they know that this happens, that it has happened in the past, and you just prefer to sleep better at night. That's the second way. The third, which is more proactive, and when we have $1 million and the market drops 20%, we know that bonds went up in value and equities went down. And what we want to do is take some of the bond allocation and put that into equities. And so we rebalance the portfolio. The shift doesn't have to be aggressive 5%. The market persists going down to negative 30, we'll take another 5% of bonds and buy into equities. If we go to negative 40 and 50, we do the same. When you do this and you actually look at the risk allocation, you have not become more aggressive. All you did is just readjust at every time proactively to maintain the same risk tolerance that you started with originally. Otherwise, you would have a disproportionate amount of higher bonds and lower equity. When we do this and the market rebounds, comes back to where it was before, $1 million has now grown by $140,000. And this is a positive outcome of our investment through a recession, of rebalancing. And now you can do that, or you can do that even more aggressively. So in this scenario, when we have $1 million and the market goes down 20, 30, 40, or 50, we replenish the amount that the portfolio has lost in equity. So at negative 20, the portfolio lost 20%. Out of the 30% bonds, we'll take 20, put it into the portfolio. And at negative 30, we'll take another 10% from bonds. And so we don't have any more fixed income at negative 30. When we get to negative 40 or 50, the problem can be we're out of buying opportunities. So in order to play this outright, we need to predetermine and the market rebounds gets back to, when the market rebounds gets back to where it was originally, we have grown the portfolio about $350,000. And when I initially looked at this scenario and I saw how the different behaviors can play out, it's a night and day type of an outcome. The first one where somebody sells, you're left with $860,000. The other one, this last one, you're left with you're up $350,000. That's a difference of $500,000, just based on control of emotions and having a plan of what we will do when that time comes. And what I found is that we cannot wait until last minute to say, well, the market is down, this is what we need to do. This needs to be discussed over and over, I would say at least once a year, and say, that recessions will come. We're lucky this year, we had a good return, but we will have that recession. And so this is the plan that we will put into place when that happens. Are you comfortable with that? To what extent do you want to do it? Do you want to do option 2, 3, or 4? Let's make sure we don't do option 1. And this is what we're seeing right now when the markets were, and that window recently was very short. This is the disappointing part, where we expected that the market actually was going to go down to negative 40 or 50. It didn't, and it made us a little bit upset, because it's like an opportunity was there for a very small window, and then it disappeared. When we're looking forward, markets have rebounded, but we don't know exactly where they will go from here. If we get a vaccine tomorrow, markets will go up. If we don't, but the government supports it, we'll maybe go sideways. But if we do expect a second wave can come in the fall or winter, then maybe it's likely that we will go to revisit the lows maybe we won't hit the negative 40 or 50 because of the government being there and still supporting us. But to what level? To how much can the government go into debt before it says, well, now it's too much? That's something we will be observing very closely, and we'll then be deciding what to do. However, having a plan of action is important. So right now we're going through every portfolio and we're having conversations to determine with clients, what do you feel comfortable with? This is the best way of going about it. How comfortable are you with to which level we're going to go? And that conversation carries through these 3 points. Do we want to rebalance the portfolio back to where it was? Do we want to take that portfolio to maybe become even more aggressive? The way I look at it, and it all depends on age, time, and income situation, and so on. But if you can rebalance back to where you were, or you can become more aggressive. As the market goes down, the risk can be perceived as lower. The lower the market is, the lower it may go down from there. When the market is high, the risk that it is, or that ability for the market to drop 50% is there. But then the more it drops, how much further can it drop? And this can become a pretty deep conversation. But if money loses value altogether, then it doesn't matter how much. If all companies go bankrupt, it doesn't matter how much money we have. And so understanding that part means that we'll be going to the store buying bread. We'll still be banking. We'll still have insurance. We'll still have a need for getting around. And if that's the truth, then there is a floor to prices of how far investments can go down. Having a look at how portfolios behave relative to the stock market, a balanced portfolio in green. These are actual numbers of returns. On the upside, when we have good years, the markets can give 8% growth, or that portfolio can give 8% growth. On the downside, that portfolio, on average, can go down 11%. When we look at large companies, large stocks, they can go 9.8% on the upside, so slightly higher. But look at the downside. It's actually 19.8, so almost twice as much on the negative side. When we look at small stocks, so smaller companies, we're not looking at Bell, we're looking at a startup. On the upside, it can go down 11.3%, but on the downside, negative 28%. And similar to international stocks, but then you look at bonds, and that gap is even smaller. So when we have a mix, what we hear on the news is always about the small companies, large stocks, and international, and that's where the drama plays itself out, and the numbers look very aggressive. But when we do a blend of these, and we have bonds in there as well, the portfolio does have slightly lower returns on the upside, but much better returns on the downside. The losses is much smaller, to the point where some investments will be performing extremely well one year, and then next year they won't be performing as well. But if we do have a mix of them, and that mix also needs to be tweaked, but in general, we're seeing that these brown circles connected with lines is where the performance ends up being. So on the upper half, so that's the basics of it. The benefit of this is that when the market does drop, like in the 70s, 74, in 2000, 2000 and 2009, we're seeing that the drops of the portfolio is about half that of the stock market. And I can tell you over the last month, the market has somewhat gone up and stabilized. We're seeing that portfolio returns are maybe at negative 5%. Some are even at zero, whereas the stock market is still down negative 15 or negative 20 in Canada, negative 25 in Europe. And so that performance is good, and pretty happy about how that is looking. So just to summarize, I think the message, or the final thoughts to leave with, is that during these times of volatility, we do need to have a plan and walk through each scenario. When the market goes down, what will we do, and how much? And if there is a plan in place, then there is no guessing, and emotions don't have to dictate the behavior. Whether we go up from here, sideways, or down, having those bases covered, it gives a level of certainty and confidence, and it does let us sleep at night. And we do I think in general, I wanted to share with everyone that we do anticipate a second wave of COVID happening. And if that plays itself out, then what will happen to the market? We'll be watching it closely, and this is something that we will likely want to share with you in the future on and what, trying to predict it doesn't work, but being ready for something negative happening is the better way of doing it. Thank you for joining us tonight. It's certainly interesting, and I hope everyone is well at home and that we do get the chance to get out and relax. I know that even being at home, we can all get a little bit shorter with, especially when we're homeschooling and so on. So with that warmer weather, going outside for a walk and enjoying the outdoors should probably make us a little bit happier. Thank you.